Let's talk about passive investing. For millions of people, it's just the smartest, simplest, cheapest way to get your money in the market. But what if that simple strategy is quietly building a brand new, complex machine right at the heart of our financial world? A machine that's changing the very rules of the game. Okay, just to get a sense of the scale here, look at this. Back in 1995, passive funds were what, 3% of the market? Barely even a blip. Fast forward to today, and they're controlling something like 40%. I mean, think about that. We've gone from this tiny niche idea to a massive force in just a couple of decades. This isn't just a small shift, it's a total rewiring of who, or maybe what, is actually deciding the price of stocks. And really, this gets us to the core mystery we're going to unpack. The whole appeal of passive investing, right, is that you don't have to think. You just buy everything, set it, forget it, and ride the market wave. But what happens when a giant chunk of that smart money isn't actually thinking at all? What does that do to the market itself? So let's get into the mechanics of it. How does this massive change actually rewire the market's engine? We're about to see how we've gone from a world driven by human hunches and research to one that's dominated by something totally different: mechanical, automated flows of cash. This right here really nails the fundamental difference. You've got two completely different species of investor now. On one side, you have the classic active investor, the detective, right? They're digging through reports, trying to figure out a company's real value. Is this stock a bargain or is it overpriced? But then you've got the passive fund, and it honestly could not care less about the price. Its only question, day in and day out, is money coming in or is money going out? And this leads us to this really crucial concept: mechanical trading. We're not talking about human gut feelings or deep analysis anymore. This is pure automation. The fund has a rule book, a mandate, and that is the law. If the rule says buy, it buys. If the rule says sell, it sells. The actual price of the stock, whether it's high or low, is totally irrelevant to that decision. You can almost think of it like a giant river. The river doesn't care if it's flowing over smooth sand or jagged rocks. It just follows its channel. That's a passive fund. When your paycheck contribution hits that fund, it has to buy the stocks in the index. And when people get spooked and start pulling their money out, it has to sell. It's this powerful, relentless force that's completely blind to the underlying value of what it's buying or selling. Okay, so this is where things get really, really interesting. These huge, blind rivers of money don't just flow through the market quietly. No, they're so massive now that they actually start to create their own weather patterns. They create a feedback loop that can take a tiny little market tremor and amplify it into a full-blown storm. So, how does this feedback loop engine actually work? Well, it's basically a three-stage rocket. First, you get the initial shock. A big wave of money comes in or rushes out, and it pushes all the stocks in that index in the same direction at the exact same time. Step 2, information starts to break down. You have fewer analysts actually doing the hard research, so prices get noisier. They're slower to react to what's really going on with a company's business. And finally, stage 3, amplification. That first jolt of volatility triggers other trading algorithms to jump in, which creates even more volatility. And pretty soon, you've got a spiral going. Now, I know this might all sound a bit abstract, a little theoretical, but it's not. Researchers have actually found the fingerprints of this feedback loop all over the market data. So let's take a look at the evidence. First thing we see is a direct link to volatility. The data shows that as ETF ownership of a stock goes up, its price starts to bounce around a lot more. For a pretty typical increase in passive ownership, you see volatility jump by almost 3%. Now, that might not sound like a crazy number, but across the whole market, it means the ride for every investor is getting noticeably bumpier. And next, stocks are starting to move together in lockstep. The research shows that as passive ownership rises, the correlation between different stocks shoots up by almost 12%. And let's be really clear here. These companies aren't suddenly moving together because their businesses are more similar. Nope, they're moving together because they're being bought and sold as one big lump inside the same index fund basket. And when you add it all up, the combined effect is, well, it's pretty staggering. Some analysis suggests that roughly 10% of all the day-to-day churn in the stock market can now be traced directly back to the rise of passive investing. That's not just a small tweak. It's a huge structural change to how things work. But look, this isn't just about prices bouncing around more. It's about what those prices actually mean. As this fascinating research from Harvard Business School points out, as passive ownership increases, stock prices get significantly worse at predicting a company's future earnings. In other words, prices are getting less intelligent. So, why is that happening? Well, it's because the incentive to do the hard work, the real financial analysis, is just shrinking. I mean, why would you spend months digging through financial filings when a huge part of the market is just gonna buy that stock anyway because a rule told them to? And you can see it in the data. Analyst coverage drops, fewer people are even Googling for company info, and way fewer are reading the official reports. The reward for doing the research just isn't what it used to be. And this whole effect isn't spread out evenly. It's super concentrated in the biggest mega cap stocks, the ones that dominate the major indexes like the S&P 500. The sheer amount of passive money flowing into these giants is so huge that it can literally create its own momentum, pushing prices around in ways that are totally disconnected from how the company is actually performing. So all of this brings us to our final question. What does this all mean for the future of the market? For any one of us as an individual, passive investing seems like a no-brainer. It's easy and it's cheap. But for the system as a whole, is there a hidden price for all this simplicity? And the consequences are, well, they're systemic. I mean, think about it. If prices aren't as smart, does money still flow to the best, most innovative companies? If all the stocks are moving together, what does that do to the whole idea of diversification? And maybe most importantly, what happens in a crisis when millions of people are all forced to sell the exact same basket of stocks at the exact same time? It suggests the entire system could be a lot more fragile than we think. And so that's the thought we're left with. Passive investing has put the retirement savings of millions of people on autopilot. And for those people, that's been a fantastic thing. But as the entire engine of the market becomes more and more mechanical, running on rules instead of reason, you have to ask yourself, who or what is actually left in the driver's seat?